Lance, welcome back to the show for our June 2025 housing market reporting.
Housing. Always so much going on, especially this year and lately.
Well, you're a housing market analyst for those who don't know, and your firm Resiclub provides up-to-date data on what's happening nationwide. And for anyone that wants to follow Lance, we have published his show notes. You can sign up for his free newsletter and as well follow him on X, where he posts a lot of really good information. And you can always follow him here on Sachs Realty. If you haven't subscribed to our channel, we have a playlist called Lance Lambert Resiclub that you can track along with us as we go from month to month and get Lance's incredible knowledge that he spends every day. Man, I don't know. Do you do anything else but follow the housing market?
A lot of housing, yeah. Well, when the football season starts, a good amount of Bengals stuff, but yeah, a lot of housing.
Well, let's kick it off, man. What are you seeing? Tell us about what you've been finding in June.
Yeah, so I'm going to share my screen and show some of my data and charts that I've been following. When we talked heading into this year, 31 of the 300 largest housing markets had falling year-over-year home values, according to the Zillow Home Value Index. And that's between January 2024 and January 2025. The next month, that went up to 42 markets. That from February 24 to February 25. Then the next month, it went up to 60 markets. And it was 20% of the market then that was falling year over year for home values. And that was between March 24 and March 2025. And around that time, I had told you that based on the trajectory of active inventory for sale, what was happening in the monthly data, and just anecdotal as well, that it looked like we were barreling towards at least 150 housing markets down year over year for home prices, which right now we're already essentially at the highest levels post GFC. Normally back in like 2016, 17, 18, 19, it's pretty normal for around 3-4% of markets to be down year over year for prices. But now, we're up to 96 markets now of the 300 largest, and that's 32% of markets down year over year for home prices. And if you just look at the 50 largest MSAs in the country, it's now over 40% down year over year for prices. A lot of these still, and I'll show the list, the major ones, Austin, Tampa, Dallas, Phoenix, San Antonio, Orlando, Miami, Jacksonville, Atlanta, San Francisco, Denver, New Orleans, San Diego, Raleigh, Houston, Sacramento, Charlotte, Memphis, Riverside, Portland, Birmingham, Seattle. That's a lot of big MSAs that are down year over year for prices. A lot of these are either in the Southeast, the Southwest, or the West at the moment. You do see, if you look at the data for active inventory and also year over year prices, you see a deceleration and a softening that's occurring nationally. So the markets that were down a little bit last year, like the Austins of the world, the Tampas, you go into Southwest Florida, the Cape Corals, those markets are now they've gone from being down a little bit to down a sizable amount. Punta Gorda is now down year over year 11%. Cape Coral, Northport metros are now down 8% year over year. The places that were kind of flat year over year last year, the Atlantas of the world, the Denvers, those places now are down a little bit. And then the places that kind of saw elevated appreciation last year of 5%, let's take my market, Cincinnati, are now up 2 or 3%. So everywhere has decelerated. Of the 50 largest markets in the country, 49% have decelerated. And the only one that hasn't decelerated has been one of the biggest outliers this cycle, and that's New Orleans. And they've gone from being down, let's say 6 or 7% year over year to being down 3% year over year. So you've seen a deceleration occur pretty much across the US housing market. And if you go through this, you'll see the biggest down markets: Florida, Texas, Louisiana, Uh, no big surprises on that front. But you are seeing this deceleration occurring.
Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's 14 lessons, includes worksheets and resource guides. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. If you've followed me here on YouTube, you know that I am very transparent in my videos. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I'd even recommend this course to most real estate agents, as they will probably learn more about the home buying process than any other training that they've received. I've even made a way for you to gift this course to your family and friends. Visit saxrealty.education. The link is also pinned in the comments below. And for a limited time, I'm offering a 10% discount on Todd's Simple Home Buying course. Just enter the coupon code TODD when checking out. Now back to the show.
National appreciation, the Zillow Home Value Index, which the Zillow Home Value Index, despite everybody giving it, Zillow a hard time for its estimates, the Zillow Home Value Index, the aggregates have actually been pretty good in terms of leading the major resale indices. So Case-Shiller, it's a repeat sales indice. So you have to wait for sales to finalize, right? And so a reported sale in February could be something that closed in November, right? And then not only do you have to wait for the repeated sales to close, but you also then have a 3-month rolling average of Case-Shiller. So Case-Shiller ends up being 5-6 months behind the real world or more. And so Zillow Home Value Index is now decelerated to 0.5% of national appreciation, but it's going to go negative in the next few months. And the other indices like Case-Shiller, Freddie Mac, FHFA, Cotality, which used to be CoreLogic, they are all decelerating pretty quickly as well. So we are seeing a softening occurring across the country. And if you zoom out, existing home sales have been at constrained levels, historically constrained levels, since the second half of 2022. So demand and what is actually transacting has been fairly low since mortgage rates shot up in mid 2022 and the pandemic housing boom fizzled out. But the longer that we've been in this constrained environment, slowly active inventory is beginning to build. Not everything is getting absorbed by the market, but yet demand has stayed low and actual sales have stayed low. But as that active inventory has built, the market is slowly beginning to feel the reality of the affordability pinch we've been in. And so that supply demand equilibrium between which I measure in active inventory for sale has been shifting directionally towards buyers. Some markets, it's been very fast, that shift, like Austin. And in some of these places, it's been a very slow shift to that equilibrium. So I have another story that I can show to really emphasize that point. Give me a second to find it here.
Yeah, while you're doing that, I mean, obviously, we're looking at numbers that historically are the best times to sell a home. We're coming off of the spring market, we're now into summer, and it's a lot harder for sellers historically because buyers are, after graduations or school lets out, they're taking family vacations. Then they're coming back in September to back to school. They're focused on buying school supplies and clothes for their kids for the new year. And then we have the holiday season. So we are coming into a time where we're looking at numbers that are, obviously the buyer demand has backed off so much so that we're seeing some of the worst home sale numbers than we've seen since the GFC. This is affecting the sellers that need to sell. It's affecting real estate agents and every related service. I know home inspectors that have let their staff completely go, and now they're handling everything themselves. They went from being busy to as many possible home inspections they could do in one day, working 6 and 7 days a week, to barely having any home inspection. So it really is hammering the industry. We kind of saw this coming.
Yeah. So as that active inventory for sale is built, the markets that have seen it go above pre-pandemic levels, above 2019 levels, those have been the markets that have seen the greatest softening and weakness for pricing. And so you take a market like Punta Gorda, where now there's 100% more inventory for sale in Punta Gorda than there was in 2019. So
Doubled.
for every one home for sale in 2019 in that market, there's now two. And in that market, prices are now down 17.6% from peak. You take an Austin, similar story, right? Austin has 71% more homes for sale in that market than the same month in 2019. They're now down 23% for prices. And so this isn't a like perfect correlation, right? You're not going to like Punta Gorda has more inventory for sale than Austin relative to its pre-pandemic base. But generally speaking, this trend has been fairly true. The markets that have built back to normal levels of 2019 active inventory have seen prices flatline or fall, go into correction mode. And so some people kind of say, well, 2019 was a low level of active inventory then. So why getting to that now? Does that translate into, potentially falling prices? And the reason is that active inventory, it's not all about comparing it from one point to another point historically, right? But it's the equilibrium in that market. And so if that equilibrium it gets to where there's now 2019 levels of inventory, to get from that ultra low level up to 2019 on the ground, that takes a pretty big shift because there isn't necessarily this big wave of listings coming on the market. Instead, it's that demand is so low that the things that are coming for sale, they're just having a much harder time transacting. And some of these sellers aren't finding a buyer. There's more sellers than buyers in a number of these places. And so as that occurs, and then, the number of days that they have to be on the market before pending increases, that active inventory builds. And to see enough of that swing to get it to a 2019 level of active inventory means that it had to shift a, a good amount, right? And so that's why you've seen the prices come down in some of these markets that have gotten back to the 2019 levels of active inventory for sale.
Well, while we're talking about that, I just want to add something because I am talking to sellers that have pulled their homes off the market across the country and especially in Florida. And what we're seeing is they tried to sell. Maybe their house was on the market for 5 or 6 months. They were unwilling to take a price drop, thought that maybe rates would come down and will relist in the future. But when talking to some of these sellers and asking them, well, how many people did you have come through your house? Well, in the first week, we had quite a few. Okay, did you have any offers? Yeah, we had one offer and we wish we would have taken it. It was less than what we wanted, but we were either the story goes that they were either listening to their real estate agent or they were just flat out not willing to take a lesser price. But again, asking them, hindsight being crystal clear, are you regretful that you didn't take that offer? And a lot of them were saying yes. So it's, what can you do? I mean, I think the sellers are starting to wake up to the fact that this couldn't go on forever. And you're right, the inventory isn't what we're seeing. It's not coming on the market. It's not flooding the market. A lot of these sellers have 2 and 3 handle mortgages. But the ones that we are seeing that are listing, they have to sell for whatever reason. So that's what we're really starting. The issue is, and and maybe you can talk about this a little bit, but when you get these, what is known as maybe an outlier that sells for 22% or 25% less than list price because they had the fire sale, they're setting new comparables in those subdivisions, in those communities. So it is solidifying in a lot of ways what a buyer can get for their home because of the new pricing, and most buyers need mortgages.
Yeah, these places that have shifted to buyers markets or into strong buyers markets, or maybe or even in correction mode. The thing about being in a correction for housing is that it takes time to play out. It's a slow dance usually. Now you can go and you can look at 2008 when there was you know, it was a slow dance into it, and then there was a really big drop at one point, right? But historically, most corrections take time to play out, and it is a game of psychology, comps that get set in the neighborhood, and sellers resisting coming down as long as they can. But over time, in those markets that are in correction, as those new comps get set, as those sellers feel start to sweat it out, it slowly begins to manifest. And some of that is maybe the seller initially, things are going well in their life, right? And they kind of feel like this is the price. I saw my neighbor 18 months ago, 12 months get this price, and they're on the market and they get some interest, but it's not up to what they want. And then, they have to pull the listing and they come back. And then they see buyers are willing to offer less than they had initially offered them, right? And so they see that shift. And then maybe they have things that happen in their own life. Maybe they lose a job. Maybe they don't get the bonus they wanted. Maybe they have to relocate. And then at some point, maybe they sell for less than, let's say 15% less than their neighbor got 18 months ago. That sets a new comp in that community. And so in these markets that are in correction mode, and not every market is in correction mode, what I consider correction mode at the moment, but the ones that are, it's a slow dance. It's a fight, and it takes time to play out. And corrections can take years to play out in housing. It's not like a stock correction where you have a 10% drawdown within a few days. Housing's not like that.
Because you can't see it. You can't see it. So you don't know what the seller took on their home until 30 or 45 days later when it settles. So that lag effect is causing people to make buying decisions on prices that they're unaware of what the prior month or 45 days ago brought the seller.
And
So it is.
there's not the transparency that you have in the stock market, right?
Right.
Where
Right.
Apple, let's say it is trading, I don't know, what's it, 203, 205, something like that, right? And, that's what people are paying for it. In housing, you can hide price drops a number of ways. If you have to do $25,000, $30,000, $40,000 of renovations and remodel the kitchen, when 12 months ago, 18 months ago, you wouldn't have had to. You could have gotten the same price. That, in my mind, that's a price drop. If they have to pay, a lot of money out of pocket, that would have, let's say 5, 6, 7% of that sales price towards incentives for the buyer, whether it's maybe buying down the rate, kind of like how the builders are doing. In my mind, that's a price drop. And so in housing, even if you go back to GFC, where these indices like Case-Shiller have national home prices down 27% from peak to trough, in reality, prices fell more than that. If you look at it through a real economic lens.
That's a great point. So where are we headed?
I think we're headed for more softening. This market is continuing to signal, as you've seen these active inventory rise year over year. I think we're headed for a greater softening in the market and more markets slipping into correction mode. I do think you're going to see sellers who can try to fight this out. Some of them are getting advice like you would you had mentioned that real estate agents telling them, hey, mortgage rates are going to drop at any moment, just keep waiting it out. And that hasn't really manifested. That advice that people got in 23, 24 hasn't come to fruition. But I think some of these sellers are still getting that advice. And so I think as you head into the second half of the year, you're going to see some of the listings get pulled. You're going to see an increase in delistings and people kind of maybe wait it out for next spring. But the motivated sellers, the people who have to sell, and that is a good number of the listings coming on the market, that are these deaths, divorces, these low levels of new listings that are coming on. A lot of those people are motivated. And some of those people in the second half of the year, they're not going to get the offers that they wanted. And I think whether it's investors or buyers, I think in some of these markets, they're going to be able to negotiate down and get something below comps. Now, where we are in spring 2026, and kind of what does the full 2026 market look like? It's a little tough to say at the moment, but if you zoom out, you can see that in 23, 24, 25, active inventory on a nationally aggregated basis rose. The number of homes on the market getting a price cut on a nationally aggregated basis rose. The number of housing markets that slipped into correction mode rose in 23, 24, 25. And so it'll be interesting to see what 2026 looks like.
Yeah, and for the sellers that are unable to sell their homes, what they really need to do is dive into the cost of opportunity, right? They have to look at, if you don't have to sell your house, then fine, sit on your 2.74% mortgage and stay there. But you also have to look at, if you're wanting to downsize, what does that cost to do to not be doing it now? So maybe you could find an incentive that would work with a home buyer or an offer today that's not what you wanted. But if the trend continues to drop, you could potentially lose even more money by waiting. I mean, I don't think, and this is where I wish I had a crystal ball. People reach out to me, they're like, Todd, should I buy? Here's the situation right now. I can't tell people whether they should buy a house or not buy a house. What they have to make sure is that they can afford the home. And you have to look at it as, if you don't need to buy right now and we're in a downward trend and price matters to you, as it should, especially if you're not going to stay there for longer, than 5 years, you may not be able to sell it for what you buy it for today if we do see a significant correction. But you have to write the numbers down. You need somebody that is going to look at the home. Does it need improvements? Can you get a home inspection? Are you willing or able to negotiate, like you said, with the seller to get things repaired? Because maybe if you're overpaying for that house $20,000 or $30,000 in its current condition, but you can get, like you mentioned, Lance, a brand new kitchen, a renovation, some type of credit. It may be that may be what it would take for it to make sense for you. So, I mean, it's very important to have the right agents if you're going to have an agent as a buyer. But Lance, tell us, what are you seeing with the new home builders? I know you're close to a lot of them. You talk to their executives. What are the sentiments right now? Tell us what's happening in new home
Yeah.
construction.
So if you go around and you talk to the different publicly traded builders, or even a lot of these larger private ones, or even if you just listen in on their earnings calls, it's pretty big consensus that among the bigger builders, spring 2025, especially in many parts of the Sun Belt, it was softer than they expected. And so Lennar is really, uh, gone the furthest in terms of trying to maintain sales. And so they've really taken a big hit to their margin and doing a lot of incentives to move product. And so on a net, Lennar's average selling price, net of incentives, is 389,000 in the past quarter. That's down from the height of around 490,000 back in Q3 2025. But if you compare it to Q2 2022, when it was 483, let me do the math real quick and tell you how much that's down. That is 19%. So they've seen a 19% drop in their average selling price net of incentives. Some of that, could be a little bit of mix shift here or there, maybe building smaller homes. But a lot of that's how much they're paying on buy downs and incentives. And at the height of the pandemic housing boom, Lennar was spending 1.6%. And let me show you this chart from John Burns. They were spending 1.6% of revenue, 1.5% of revenue on incentives. And this is revenue of sales, home sales. And now they're spending 13.3%. So if you do the math there, that means on a $450,000 house, they were spending $8,000 in incentives. Now they're spending $60,000 on incentives. Lennar is really big on the mortgage rate buydowns. So that's where a lot of theirs is going. And some people have shot back to me, well, Lance, isn't that just a normalization? Well, normalization is Lennar spending 5 to 6% on incentives. And actually, here's a direct quote from their CEO earlier this year. These are outsized incentives for the moment. Normalized incentives should be around 5 to 6%, and they're at 13.3%. A lot of this is in Florida, Arizona, Texas, these markets that have seen the greatest softening, but it's really also happening across the country as well. Even in the East now, the average selling price for Lennar net of incentives is down 8% year over year. And actually, some of the markets that have done even in the South, Central, that's not as much down as the East. So the East on a year over year basis is seeing a notable softening for Lennar. Now, some of that is because the West, the Central, the South Central, those are pockets that have already seen more softening from Lennar. And so the Northeast has kind of caught up to some of that. Now, for margin, Lennar's margin is now at essentially a decade low. And you can find a quarter, Q2 2018, when it was lower than the past quarter. But that's because they had a purchase of a company that pushed down the margins for that quarter. And really, if you account for that purchase, it really should have been around a 21% margin for that quarter. So 17.8% gross margin is a pretty big drop off, especially considering they had a 30% gross margin at the height of the pandemic housing boom, and normal for them was around 21, 22%. Now, Lennar has been able to maintain sales volume relative to some of the other builders. Now, a little bit of this jump the past quarter is a little bit inflated. And the reason being is that Lennar purchased Roush Coleman Homes, which is a builder in the central part of the US. And so some of that is contributed to the elevation. But another reason that they're elevated is that Lennar has just chosen sales pace over margin. And so they've taken bigger hits to their margin to do these bigger incentives. And here you can see the sales year over year. You can see it's up pretty much, well, it's up nationally, but a lot of that's also driven by their acquisition, which is in the South Central part of the US. And so give me another second here. Here's the stock prices of the builders. You can see there's been a pretty big drawdown since the height of last year. In 2022, builder stocks took a bit of a hit as the mortgage rate shock occurred. But once the builders did their affordability adjustments, met the market, and sales kind of jumped back up in 23, there was a big jump up in home builder stocks. But what's fascinating here is that the first part of this chart, between January 2020 and January 2022, home prices on a national basis were up around 40%, right? And so this is the jump in builder stocks that occurred there. This second half of the chart, national home prices are up 2, 3, flat, right? And they've seen all of this jump up in the stock. And so in 2023, Warren Buffett bought some of the home builder stocks, D.R. Horton, Lennar. And Warren Buffett has this famous quote that if you're not willing to hold a stock for a decade, don't hold it at all. 9 months later, he sold off his home builder stock,
I remember that.
which is kind of interesting. And they did continue to climb a bit after Warren Buffett sold off, but a few months later, they peaked out around October 2023, and they've really rolled off their highs. Now, the past few weeks, they've kind of flattened out a bit, and a couple of them have ticked up a bit. So keeping an eye on them. But the market, that drop off that we saw is because Wall Street was pricing in that the builders were going to have to do bigger price cuts, bigger affordability adjustments, mortgage rate buydowns, all of that stuff to continue to maintain sales volume. But some of these builders aren't maintaining. Some of them are pulling back. And so I was at a private event in New York earlier in June and heard Toll Brothers CEO speak. And he said that right now there's a bit of a spec problem in some of these markets. He said Phoenix, Austin, some of the parts of Florida. And he says as much of 1/3 of the active inventory for sale in some of these markets is unsold completed spec inventory. And so he said that he thinks this is going to be temporary, and he thinks that builders are going to pull back because of it. And so they're going to do less spec inventory. And so the past 24 hours, I've had 7 sources reach out to me to tell me about layoffs at Lennar, which is kind of interesting because Lennar is the builder that has continued to try to maintain sales space. And so even they're doing layoffs. And I can tell you some of the markets they've laid off. A source told me they laid off 30 plus in their Charleston division over the past week. Lennar eliminated a large number in their Georgia divisions. A third source confirmed the Georgia division layoffs. A fifth source said they laid off 9 in Denver. Sixth source said layoffs in Huntsville, Alabama. A seventh source said Lennar had 4 layoffs in Myrtle Beach. And then another source told me that these were nationwide cuts, which based on the anecdotal sourcing that I got, I think that that's the case. And Lennar hasn't reported this. I couldn't find any headlines for it. But I can tell you that all 7 of these sources, I have confirmation that they all work in the industry and they're all people I've communicated with in the past.
Well, let's take one step back and talk about the private meeting that you were in June in New York, listening to Toll Brothers. Just for clarification, so everybody understands, was there any clarity on now spec home? It could have been built that way, right? They just decided we were going to move forward and build a home. A spec home is, hey, we're going to build it and put a for sale sign on it, and maybe they will allow the buyer, they'll stop short of putting in a carpeting color or a flooring or appliance package or whatever. Maybe they'll let the buyer have some say, but the house is pretty much ready for a quick delivery. Did they indicate of this climbing spec inventory, how much of that, or do you have any idea how much of that was because contracts fell through, where buyers just decided they weren't moving forward, they gave up their deposit money, maybe, but just backed out?
Yeah, so I don't exactly know that end of it. I can tell you that where they're seeing the most is in some of these Sunbelt markets. They've said that they've still had decent success in their Northeast and Atlantic markets. So everywhere from Boston to Northern Virginia, those were markets that they said were kind of sleepier during the pandemic. Obviously, they weren't too sleepy. There was still a boom in those places and prices went up, but relatively to some of their other markets, on the softer side, they said Florida inventories are up. Parts of Texas, Phoenix is adjusting with a bit of high inventory. Anytime you hear the builder say adjusting, that means like net effective prices are falling. A lot of that inventory for existing homes is builder spec because all of those markets have big builders there who committed to a spec strategy. So it sounds like they're saying that they were actually intentional specs, but there's probably definitely going to be some contracts that fell through and attributed to that as well. He said he's heard as much as a third of the overhang in the resale market right now is actually new unsold spec. And he said over time that'll clean up because builders are starting less spec in the softer market and it'll naturally work itself out. And then he said Austin home prices doubled there through COVID and they're still trying to adjust a bit. And so this was a private event with 150 institutional groups that were there. And Toll Brothers gave some very candid insights. If you want to know some of their other things like tariffs, they haven't really seen much of an impact there on building material cost yet. When it comes to the NAR settlement, they thought it would put significant downward pressure on broker commissions. They're not seeing it yet. They don't really want to be the leaders there trying to, cut down on commissions, but they're going to follow whatever the market does. And if the market goes to flat fee, which of course Toll Brothers, who has an average sales price around $1 million, would love to see that. They said they'll follow it. And so they would like to see the market go to like a flat fee, like let's say a $10,000 flat fee instead of percentage based. And here's a nice chart I have here of margins. You can see this margin compression has pretty much happened across the publicly traded builders as they've had to, do more incentives, more buy downs, outright price cuts to maintain or just not to see as big of a drop in sales.
Well, I want to just take a minute and talk about the commissions that you mentioned, because during the boom cycle, these builders weren't offering, a lot of builders weren't offering much of a commission. They didn't need to incentivize an agent to bring their client by because they were making a lot of money. They were selling regardless of whether they had an agent or not. And they were limiting the amount of homes that they would release on a monthly basis. And that kept the demand high. It kept the pressure on. Look, we're only allowed, I heard builders say, look, we can only release 4 new homes a month. And that really helped them to apply that pressure to the buyer to make a decision right then and there. Yeah. But I just came out with a course, Lance, a home buying course. One of the things that I say in it is if you're a buyer and you are looking at new home construction and you have not yet signed a buyer agency agreement, you can ask that builder if should you get a agent, should you go and find, you haven't decided yet, but should I have a buyer's agent? Are you offering a compensation to that buyer's agent? If they say yes, ask them how much it is and write it down, because you could come back to the well if you don't have an agent and ask for that money. It's already built into the house. It's already built into it. So why not? It may be that difference that it takes that you can do some landscaping in the backyard, build that patio or deck or whatever. So I just wanted to put that out there because a lot of people don't realize that the builders now are really incentivizing buyers agents to bring them to us. We'll pay you. I've seen a lot of commissions offered to agents by these builders.
Yeah, I actually did that with my house that I bought. I was able to ask to get the amount that would have went to the agent off the price. I kind of dragged my feet a little bit and was able to ask to get that off.
It could be a lot of money. Let's just say they're offering 3%, for instance. If it's a $600,000 house, that's $18,000.
Yeah, and especially when you think about it as a 30-year loan, right? You're paying interest on the entire duration of that loan. And anything else that we want to get into here? Do we want to get into the number of homes underwater? KB Home.
Let's talk about it. Yeah, let's talk about that.
Yeah. So while around half the country is down from the peak, and we've seen some of these markets fall 5, 10, 15%, and even like Austin, 20%. I wanted to find out how many mortgages are actually underwater. And so I reached out to ICE Mortgage Technology. They're formerly known as Black Knight. They were acquired by ICE for almost $12 billion recently.
Is that it? $12 billion.
Yeah, they're a pretty data player. Yeah, in the housing space. And their data shows that around 1% of outstanding homeowner mortgages have negative equity. Comparable. And yes, I understand if we were to see prices fall further, that maybe comparing it to September 2009 isn't the best comparison, but I wanted to give people some ballpark. So in September 2029, 23% of US mortgages had negative equity. And then there was a share that was almost the same size as that were borderline negative at the time. And you had places out around Las Vegas and in Arizona and in Florida where 40% of the market had negative equity. And so why aren't more people underwater at the moment? Well, a few things, which is nationally aggregated prices are kind of still closer to the peaks, right? Especially in the Northeast and Midwest, where maybe it's a little bit above 2022. So that's one reason. Another reason that's helped people out is the amortization of the ultra low mortgage rates. So if you go and you do the math, out of the gate, you're paying down a bigger piece of the principal right out of the gate with those lower mortgage rates. And so having the fact that, at the end of last year, still 54% of the people had these rates below 4%, uh, that's created a little bit of a bigger equity buffer. Another factor is that the markets that have seen these bigger corrections, like Austin and Cape Coral, it was a smaller share of homeowners who bought at the absolute peaks, right? Austin had a really big shoot up, right? And the pandemic housing boom, and had another like 10-15% jump up in the first several months of 2022. And then just nosedive down. And by the end of 2022, it blown off 10% of the price. Whereas GFC, when you hit that 2005 peak, we sat there for a while, right? And then we rolled over. So there was a lot of transactions that occurred 05, 06, 07. Now, I say all of that, and if prices were to now fall or fall materially in some of these markets, you've had a good number of people transact in 22, 23, 24, early 25, closer to these peak prices. And so if now you were to have a rollover in prices of, let's say, some of these markets 10, 15%, that would create a much bigger issue because a lot more of these buyers are coming in with higher rates. So they're not paying as much down on principal right away. Some of them are coming in barely being able to afford it, right? Versus a lot of the 2021 had higher credit scores, less debt to income back then. And so we are starting to see the number of markets that are crossing that 4 or 5% threshold of negative equity. We're starting to see it rise. So you can see in the West and a lot of the Midwest and Northeast, you don't really have many of these mortgages with negative equity. But in some of the pockets of Texas, Florida, Louisiana, where prices have fallen more, you are starting to see it rise. And if you zoom in at the numbers even closer, you can see which vintages are starting to see it. And so take Cape Coral, Florida. 8% of all outstanding homeowner mortgages in that market have negative equity. But among 2023 and 2024 vintages, it's 27%. And so
Yeah.
that goes back to what I'm saying is that
Yeah.
if prices were to roll over more, the vintages that would become the problem are the 22, 23, 24, 25 vintages that would be the issues. And
That's a great chart.
and 2021, it could be that the vintages, because I don't have this confirmed, they might include refis. And so it could be that some of these 2021 vintages could be buyers that were, I don't know, 17, 16, right, who wanted to get the 3% mortgage rates. I'm not sure. I'm not sure if this is vintages of only those who transacted or if it also includes the refis.
I want to add, while this chart's up, I also want to add another element to that because being in home sales during this period of time, there were a significant amount of buyers, and over a appraisal gap contingency was a very common part of the contract, this addendum from 21, even in 2020, towards the end of 2020, when people started getting out of the house again, right? The initial lockdown, nothing was happening. But then as people started buying homes and people were allowing buyers to come through their home, from about the end of 2020 to, like you said, the peak in 22, there was a large percentage of contracts where the buyers submitted that an addendum that said that they would pay X amount of dollars over the appraised value in order to get the loan. That's not even considering this. So we saw where a lot of buyers had gift money from mom and dad, $50,000, $100,000, $150,000 over appraised value. Should it not appraise, that they would come to the table with this cash. This chart doesn't even include that. I mean, it would be really hard to determine that and extract that data, but I just wanted to add that because there are a lot of people that overpaid. The appraisals could not keep up with the price demand. It was the appreciation was happening so fast that the appraisers are like, I can't justify this price. I mean, you 15%, 20% in some cases over list price. How can I adjust it? The price was housed based on the comparable sales, and now you just sold it for 15% more than that. You need the cash. So, yeah, what do you think of that?
Well, I think the thing to keep an eye on here is we haven't seen necessarily much distressed sales, or if they're distressed sales, they don't really identify as distressed sales that are detectable. And what I mean by that is somebody in this market where, they have a lot of equity, and prices haven't fallen that much in maybe their market, but they've kind of run into financial problems. They could go out and sell that home. And, if they are willing to meet the market, or wherever their market is, if they're willing to meet it and they transact, that doesn't really get detected as a distress sale, right? But as you start to see a rollover in prices in some of these markets, and maybe if we even saw unemployment rise, right? Um, you want to keep an eye on the markets where the share of borrowers with negative equity has risen, like these Cape Corals, Lakeland, Florida, San Antonio's, Austin, Texas, Northport, and just keep an eye on what happens to their foreclosure numbers, because I think they would be leading in terms of whatever we start to see nationally. Now, I still don't think this is the, GFC foreclosure wave. I think that, we do get buffered by some of the, differences this cycle. But I do think that the number of foreclosures that are going to happen is going to rise. Some of those numbers have been suppressed through different government programs that have tried to prevent those foreclosures. And if you look at the leading data for foreclosure starts from ICE, you can see that the numbers have kind of gotten closer to pre-pandemic levels now. And if you look at the number of borrowers in 90 days delinquent, it's risen. It's not too high, but it's back to pre-pandemic levels. And then if you look at 30-day, it's above pre-pandemic levels. So I do think that the data suggests that that is shifting and we're going to see more of it. But in terms of like how much does it end up being, we'll have to keep an eye on it. But I think the things to follow are what happens in these markets where more homeowners have negative equity. And that's places like Cape Coral, Florida, and Lakeland, Florida. And somebody messaged me and asked, somebody who saw my charts, and they asked, well, how much equity do these borrowers have? If you're underwater, you have no equity. That's what that means. And so some of these people in some of these markets, they might just have a little bit of negative equity, but some of them, especially in some of these pockets of Austin that are around a lot of these big builders, it could start to be a bigger amount. And the thing is with housing, even if you're kind of close, you have just a little bit of equity, or maybe you're slightly negative equity, keep in mind there's transaction cost too, right? And that affects.
To sell.
Yeah, exactly. Yeah, because
Yep.
historically, how it works in the U.S., and you know this better than anybody, is that the seller is usually the one on the hook, not just for their transaction costs, but also often the buyer as well.
If people can hold on to their homes, history tells us that prices will again rise no matter how bad it gets. We saw that with the GFC. Sometimes it took a decade to get. In some cases, we were seeing where, well, even longer than that. I saw in some instances where my sellers purchased their home in 2006, and it wasn't until the peak of 2022 that they could actually sell it for slightly more than what they bought it for in 2006. One in particular I can think of. The issue becomes, have you kept up with the repair cost and the maintenance on the home? Or is it, like you said, distressed to where that becomes even impossible to get what you paid for it? Lance, I know a lot of this is predicated on, and it's kind of hard no one has a crystal ball, but a lot of this is predicated on America buys monthly payments. And when we see that the homes today, the prices of what we're seeing before we're seeing any of the correction, these were really prices that were generated from mortgages being in a 2 and 3 handle, under 3%, in a lot of cases, 2.75%. What do you think? What are you finding as far as mortgage rates? Any indications on whether there will be some type of quantitative easing where the government starts buying mortgage-backed securities again and can suppress these mortgage rates? Do you think that will happen? Or are we really looking at a longer term of 40 and 50-year running averages for the 30-year fixed rate mortgage of around 7%?
Yeah, so I'm going to share my screen again and go through some data here. Uh, While there's a historical relationship between short term and long term rates, the Federal Reserve's short term rate does not directly set the long term rates like mortgage rates. And what I mean by that is if the Fed, cuts short-term rates by, let's say, 100 basis points, it doesn't mean mortgage rates have to immediately drop 100 basis points. And actually, despite the Fed cutting last year 100 basis points, and the dot plot released by the Fed signaling they think at least another 50 basis points of cuts this year, mortgage rates have not materially changed. As of yet. And some of that is because of the market's views of employment, and also still thinking the Fed's in a little bit of an inflation prevention mode. So here you can see the comparison of short-term and long-term rates. The green line is the 10-year Treasury yield, which mortgage rates trade the closest to. The red line is the average 30-year fixed mortgage rate going back to 1972. And then the black line there is the federal funds rate going back to 1972. And you can see that directionally they often move in a similar pattern. Now, in terms of what actually drives demand and pricing for mortgage backed securities, it is the demand for the underlying bonds, right, for the mortgage backed securities. And so, at the market expectations of the future environment, because financial markets are forward looking, if investors foresee a sizable shift in economic growth or unemployment, inflation, or the Fed's policy, they could reprice bonds accordingly and move yields before even some of the hard data changes. Inflation expectations, uh, you know, uh, investors want to be compensated, right? If we're going to be in a higher inflation environment. Economic uncertainty, flight of risk. If a crisis or recession triggers a flight to safety, there could be more demand for the mortgage backed securities for those bonds. And how bonds and yields work is they're inverse of each other. So if demand for mortgage backed securities rises and the price of those bonds rises, the yields the mortgage rates will fall, right? If the demand and the prices of those mortgage-backed securities falls, the yields and the mortgage rates rise. And so during periods of quantitative easing, when the Federal Reserve is out there buying mortgage backed securities, like during the pandemic period, that's driving up the prices and demand for mortgage backed securities, and it drives down the yield in the mortgage rates. So mortgage rates are suppressed, artificially suppressed. And if the Fed is out there selling the mortgage backed securities, that would do the opposite. And so right now, we've been in a period where it's technically quantitative tightening. And really, they're just allowing some of those mortgage backed securities to fall off, to roll off. But if the Fed had been outright selling them, going out and trying to sell more of these mortgage backed securities and not just allowing them to roll off, mortgage rates would have actually been higher right now than they have been. The supply of bonds also plays a role. If there's more of the supply of the mortgage backed securities, that can push up yields, term premium, prepayment risk. Those are all things as well. But if you zoom out and you ask me, Lance, what would actually create lower mortgage rates, materially lower mortgage rates? I think it would be a notable rise in unemployment. If the unemployment rate were to shoot up faster than expected, we saw a notably weaker economy, there would be some of that flight to safety. There would also be a Fed response. The Fed response could just be cutting the short term rates. It could be buying mortgage backed securities if it was intense enough. Although I think the Fed has kind of seen what happened the past few years during the pandemic period. And I think they might be a little less willing to buy mortgage backed securities given what's occurred. And so I think that would be the thing that would most likely drive down mortgage rates more than expected. Historically, I've read research where an unexpected decrease in the Federal Reserve's short-term rate by 100 basis points has historically correlated with a 50 basis points drop in mortgage rates. And I think if you go up here and you look at some of these emergency cuts, you can see that mortgage rates during those periods rolled over, but didn't see the same drop that maybe the federal funds rate saw, right? You saw a bit of a drop, but not the full drop that occurred to the federal funds rate.
Mm.
And so if you zoom out and you look at the Fed's bullseye chart, and so there's a report that the University of Chicago put out before the pandemic, I believe. Yes, August or before 2021. It was August 2020. It was before all of the inflation broke out. And it's called the bullseye chart. And so it's where the Federal Reserve wants to have policy. And so you hear about, the 2.0% Fed target for inflation, but really the Fed it's not saying that it has to be under it. It's saying that that number is the goal. But if it's a little bit below it, it's a little bit above it, that could still be in the bullseye. So up to 2.5% or down to 1.5. And then the unemployment rate somewhere between 3 to 4.5 is in the bullseye. And so if you look at the numbers right now, we are in the Fed's bullseye. The inflation rate is 2.4% for just normal CPI. If you do look at it for core, it's 2.5. But it's at the higher end of their bullseye, but it's in the bullseye. The unemployment rate's 4.2, so it's in the bullseye. So the Fed pretty much is telling you, based on their own methodologies, that they have the room to cut some and go to neutral if they wanted to. But if they also wanted to kind of hold here longer to kind of make sure that, none of these measures in terms of, the duties and tariffs put any pressure on inflation, if they want to hold here longer, they can. But I think the market is expecting some more Fed cuts and the Fed going towards a neutral. Goldman Sachs thinks it'll be 75 basis points of cuts this year, they said today. And the Federal Reserve's dot plot shows closer to 50 basis points. But if the labor market, which has softened, if it were to soften faster than expected, that would be where financial markets get ahead There's a bit of a flight to safety, and also the financial markets start to price in a bigger shift for longer of Fed policy to maybe uh, support lower rates on the Fed policy. Another thing that could potentially help to get mortgage rates down a bit is if the spread could begin to lower. And so historically, there's a 1.76 percentage point gap between the 10-year Treasury yield and the 30-year fixed mortgage rate. That's since 1972. So if the federal so on average, if the 10-year Treasury yield is at 4%, historically, the average 30-year fixed mortgage rate would be around 5.76%. But since the Federal Reserve hiked rates and stopped buying mortgage-backed securities, that spread's blown out. And so it got closer to 300 basis points, 3 percentage points at the height. It has slowly compressed to 2.4 percentage points or 240 basis points. But if it were to uh, normalize all the way, we would be somewhere closer to a 6.2 percentage point mortgage rate for the average versus a 6.8 right now. But with it might not normalize as fast as people think. And it might normalize very gradually. And even then, it might not get all the way back to that average. And a part of the reason and speculation for why it could take a really long time to normalize is that the Fed was buying mortgage backed securities for so long, and the market became very dependent on the Fed being the buyer of those securities. And so when the Fed pulled out of buying mortgage backed securities, there wasn't this natural buyer who stepped up to get them. So it could take time for, international markets or banks or whatever firms to step in and buy these securities. But as of right now, there's still a pretty wide spread for mortgage backs or for mortgage rates. And so last year, we start to see the average 30-year fixed mortgage rate start to fall late last summer. And it got down to 6.1% back in, I believe, August, September. Some people thought that was because the market was kind of expecting the Fed's cuts. But a lot of it was because last summer, there was real concern that the economy was going into recession. And the reason being is that the unemployment rate was shooting up fairly quickly. It's not that the unemployment rate got high, but it went from the low of the cycle of 3.4 to around 4.1, 4.2 in the summer of 2024. And the number of people, if you pull back the data, the number of people actually unemployed jumped up from 6.1 million in January 2024 to 7.1 million by July 24. And it triggered the SOM rule. And every time in history that the SOM rule has been triggered, the US economy within 6 months has gone into recession. Well, it looks like so far that recession warning was a false warning so far, and it's rolled over a bit. And so then once the market started to realize later last year that the unemployment rate was kind of, the labor market was still softening, but it wasn't breaking, right? The labor market wasn't breaking. So then mortgage rates kind of popped up closer to where they have been and where they still are today. But if we were to see the unemployment rate again start to shoot up, those longer term yields, including mortgage rates, would begin to pick up as well. And so, how would that impact housing? Well, it's tough to say because the thing is, if the mortgage rates were to fall in an environment where the unemployment rate is shot up, well, mortgage rates falling, that could spur some more demand. But if the underlying reason, because more people are losing their jobs, uh, it might not create as much housing demand as people think, those lower rates, because even the people who keep their jobs, some of them are going to be scared about losing their jobs. If you are in an environment where the unemployment rate goes from 4% to 7% very quickly, even the people who don't lose their jobs, that other, 97% of the workforce, a lot of them are going to be a little uneasy and might not be willing to do a longer term purchase of a home. And it could and then you also get to the factor of what is the regional variation, right? Are there particular industries in the country that blow out? If you go back to GFC, a lot of the, up where I live in the Midwest, we didn't see home prices run up as much as some of the Sunbelt markets, right? But the great financial crisis and even the several years leading up to it, there was a pretty big manufacturing bust that was occurring. And then once GFC occurred, the manufacturing rollover that was occurring accelerated. And so a lot of the pockets of the Midwest, especially in Michigan, were pretty hard hit by the housing bust. And not necessarily because prices had went up so much, it was the unemployment side that really impacted those areas. So if we were to see mortgage rates come down, how that impacts housing, a lot of it could come down to why mortgage rates are falling. If it's, the spreads compressing more and maybe the Fed has just gone to neutral and that's kind of taking a little bit off as well, it might kind of firm up some of these markets potentially a bit. But if it's because unemployment has really jumped up, it might not necessarily play out how some people think.
Yeah. And if unemployment jumps up, it may cause a lot of homeowners to sell because we know that, most homeowners, they need two jobs to pay for their mortgage payment and housing related expenses. So we have seen where people have lost their jobs and are selling their homes because of it. So yeah, well, Lance, great information. Thank you so much for bringing your wealth of knowledge to our audience. And looking forward to seeing what July's data looks like and having you back next month.
Awesome. Chat soon.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.